All right. Happy Friday, everybody.
Turn you up
As
just a smidge.
everybody is getting in. We'll take a few minutes and have some fun with our guest. Today we have Teresa Rose joining us, who is the president of Western Ohio Mortgage Corporation. And for those of you that I have not met, I'm Melissa Langdale. I'm the president and COO of the Mortgage Collaborative, and we are thrilled that you are with us today. We are normally joined by Rob Chrisman, but he is unfortunately caught up in travel challenges. Teresa, you and I are going to be flying solo today, my friend.
That's okay, but he's going to owe me one
Yep,
for
yep,
sure. Owes
yep,
me one.
yep. Well, okay, so as everybody starts getting in, I want to ask you a question that I think is one of my favorite questions to ask everybody. And, with your extensive history in the mortgage space, I think you know of all the challenges our industry has had over the years. But if you could fix anything in the industry and you had unlimited resources to fix it, where would you start?
Well, it depends. Do you want to listen to my cuckoo clock? Do you hear the music playing in the kitchen here?
Oh, no, it's fine. We can't
You
hear
didn't
it.
hear it? Okay. Because I have this cuckoo clock. I'm one of the few people that have cuckoo clocks. So we got it. We were in Germany, and when in Germany, right? You
I
got to
love
have
it.
a cuckoo clock. So we have one in the kitchen, and it was going off. The sore point that I still have in the mortgage industry as an owner, and I think a lot of us feel this way, is there are still problems with LOCOM. And if I could fix that, that would probably be the one thing that I would focus on, because it creates, for one thing, we truly don't have the level playing field we all think we have, because of the different channels and the way those channels work when it comes to compensation. And it's also detrimental because sometimes there is a reason to maybe need to do um, something special for a particular borrower and not be considered a fair lending violation in doing it, right? That you need to either throw in a little compensation, or the loan officer says, look, this has gone completely sideways, not the borrower's fault. The seller's extended 1,500 times because they're not really ready. We've lost our borrower's rate lock. There's got to be something we can do. And we're sitting here going, well, who's paying for it? How are you paying for it? So I do think that needs revisited, and that would probably be my number one thing to fix.
So to catch up everybody, and Teresa and I've had a lot of discussions around this, but if what we're talking about really is the regulation around LO compensation. And Teresa, I don't want to put words in your mouth, but I think what you were saying is the challenge really is the ability to be able to decrease LO compensation, especially when it benefits the consumer. Currently, the regulation does not allow for it to go up or down during the process. When things like that come up, there and the company doesn't have any more margin to give, what's the feasible solution in that? So did I summarize that okay for you?
Yeah, you did. And I think that the reason that because to the average person looking at that, they're thinking, well, what's the harm in it going down? And I think their whole reason is, well, if it goes down for this consumer, it has to go down for all consumers. You can't just pick and choose. And I think that's what they're hung up on, is that we're going to pick and choose who gets benefit of that. And it's not going to be a level playing field, when in fact, there are ways that you could manage that you could regulate that, and still make it work for everyone. And it really does need to get another look. And hopefully that's maybe on somebody's plate this year. Maybe we'll get it looked at.
We'll see. We are going to continue to try.
Yeah.
It is always a challenge. For those of you that are just joining, but actually I'll go ahead and reintroduce for those that are here right now. And if we have not met, I'm Melissa Langdale. I'm the president and CEO of the Mortgage Collaborative. Today's special guest for the rundown is Teresa Rose, who is the president and owner of Western Ohio Mortgage Corporation. Rob Chrisman is normally here, but he is not able to join us due to some travel challenges. So it's going to be the two of us kind of flying through everything today. And Teresa and I started off with a really hard question, and she answered it beautifully on kind of what she would start to do to fix the mortgage industry if she had unlimited resources. I think, you know, Teresa, you obviously are actually, I'm going to take a step back. Maybe not everybody knows about Western Ohio Mortgage.
That's
Can you
very
share a little
possible.
bit about who you guys are and what makes you unique?
So we are celebrating our 25th anniversary this year. I have been in the business for 40 years. I started at a commercial bank. I was there for 12 years and worked for a brokerage, or I should say, partnered with a brokerage for 4 years, and then founded Western Ohio Mortgage in 1999. We are regional. We are primarily focused on the state of Ohio, but we do business in Indiana, Kentucky, Tennessee, Florida, and Michigan. Just starting in Michigan, actually, but very much focused in that tri-state of Indiana, Kentucky, and Ohio. We There's not too much of any products that we don't do. We do reverse mortgages. I am a CRMP. I have had that designation. Last I knew, I'm still the only one in Ohio that actually lives in Ohio that has it. There are some people that operate in Ohio that have it. But it is a designation as a reverse mortgage professional. I got my CMB in 17. That was probably the biggest challenge of my career right there. That if you haven't done that, it's definitely worthwhile. You find out what you don't know, and then you stress over mastering it so you can take the, not just that written test, but then having the oral exam. That's kind of difficult when they're asking you all these questions. There's three people firing questions at you, and you have to really be able to think on your feet. But we do FHA is really where I started my career. In fact, when I worked at the bank, that was the only product I had for a long time. We didn't even do conventional loans when I started. And I learned it by somebody handing me, here's this at the time, the 4155. Here's the 4155. And then they sent me to Columbus to one of another company that they warehoused for. They sat me with a processor for about 6 hours and sent me on the street. So that was the extent of my training. So I've done just about every job there is to do in the mortgage business because I started my career as an originator. And then when I founded Western Ohio Mortgage, I had to create every system, including, how do we deliver the loan? Who are we warehousing with? Who are our investors? Payroll, HR, insurance, everything you have to do. And if I had, it's exhausting to even think about it now. If I had to do it today, I'd pass. I don't think I could even try it again. So that kind of
Luckily, you
sums it
don't
up.
have to, and all that hard work is paid off as you guys are
Oh
in
my
your
God.
so.
Yeah, it's a lot of hard work. A lot of hard work.
That's fantastic. And you actually are a part of TMC's advocacy committee as well. And so a lot of our discussion today is going to be focused on kind of regulatory change or rulings that have happened recently. But before we dig into some of that, I'd love to hear about, it's springtime. I don't have flowers on my shirt, but it's at least green. I think what everybody's feeling at this point is that volume is starting to pick up a little bit. I'm
Mhm.
sorry for my dog. We had this conversation right before we went on the
Hey,
air. My dog was so
mine's being
quiet and
sequestered
would
in the
not leave
bedroom
his
right
leash.
now. Yeah. My husband has him corralled in there, or he would be running around going, "What are you doing?" or "Let me out," or something. So,
She's such a cutie most of the time, and then all of a sudden random barks are happening. So I apologize. But all right, spring season is upon us, and I'd be curious to see, are you guys feeling the same thing? Is your volume starting to pick up? Where are you kind of seeing the lift in the marketplace?
we are seeing a small increase, not quite as much as I was expecting to see, because this historically, I'm going to say actually, we're probably right at the date. So starting on Monday, from Monday through the end of April is historically when the most listings hit the market. Now, whether we'll actually see that this year, I can't say, but so we're starting to see an increase. I have to say we are primarily a referral based company. We receive some stuff organically through the website or people see posts and they know who we are and they're curious, or if they're specifically looking for mortgages in Ohio and they Google that, Western Ohio pops up. But the vast majority of our business has always been and will likely remain referral based. So, that's where our lift comes from, is from our realtors. We do have builders that we work with. But I'm going to say that primarily it comes from the real estate community, which is, why this NAR thing is so puzzling as far as where it's going to go and how it's all going to shake out for everyone.
Yeah, I think that's a great topic for us to touch on next. For all those that are here, I mean, we don't know anything that everybody else doesn't know in regards to like where the things are going. And to level set, really, here's what we know, right? We know that the plan needs to be court approved still.
Yeah.
Uh, we know that the MLS is going to change and that compensation offers were not going to be listed there anymore. And that we know that buyers are going to have a buyer's agent agreement, right? So really those three things are the things that we know today.
Mhm.
But you're right, there's a bunch that, our realtors are coming to us for answers, our loan officers are looking for answers. Are there things that you're doing to help educate your loan officers, help educate your realtors around, what you think might be coming or what might be feasible in the future based on, I don't know, what we know?
So it's, first of all, it's puzzling to me the, the number of realtors that are coming to us, right? You would think that their source of information would be their brokers. Their brokers really, they don't have a direction. And my theory on that is NAR might normally be the one to give them direction and say, hey, here's how we're going to work this all out. But they're in open litigation, right? They don't have a settlement yet. So I don't think they can come out and say, hey, don't worry, guys, we have this figured out how this is going to work, because they really can't, can they? I mean, the Department of Justice is now saying, oh, wait, we might have something to say about this settlement. We're going to chime in and we may influence the judge's decision as to whether they even accept this settlement from you guys. So I think they're being overly silent. I assume that that's the reason. So every broker that we talk to has a different opinion. Some of them are just keep doing everything the way you always have, and it's going to be business as usual. Well, I don't know that that's true. And I definitely am one to have a plan B. And so taking the approach of nothing's going to change and there's no plan B is not, what's the adage where they say, failing to plan is planning to fail, I guess, right? And so then there are others that say, oh, this is a total game changer. It is going to be dynamically different. So there's a huge wide spectrum. I know in our market, a lot of the realtors are scared. They're really afraid that their livelihood is in jeopardy. And they're coming to us saying, well, are we going to be able to finance this stuff? My personal opinion is, well, first of all, we know there is no vehicle right now to finance it, right? But at least FHA has said, hey, if the seller pays it, we won't count it in the 6% concession. We don't consider it to be a concession. VA's been silent. VA's got to say something. I think we'll probably talk about that a little bit. But I personally don't think it's a good idea to finance it, because and we have to educate people on this. Actually, Adam, who works for me, Adam Rose, he has a podcast, a mortgage guy, cheap plug, and he goes over a lot of these topics, just industry topics, and then also has some local people, builders and renovation people, things like that, to try to educate the public. And we did a podcast about this, about, well, what are we going to do? And I had said the reason I don't think it should be financed is because we already know that for the last 50 years or better, 5, 6, 7% of real estate commission has been baked into the appraised values of the properties as they sell, right? Because most of the people who get top dollar for their real estate used a real estate agent. It was not a for sale by owner. Most for sale by owner properties sell for less. So it's already baked into the appraised value and the sales price. So now in this, what will be a new environment, while the attorneys who fought this or presented this suit tried to say this is going to bring the price of houses down, we all know that the seller is not likely to reduce his price. He's going to hire the real estate agent and say, well, my neighbor's house sold for 350, you get 350 for me too, right? Well, what are you going to pay then, a full 6% real estate commission that I can then maybe pair off with a buyer's agent, even though I can't advertise it? How's that going to look, right? So if we then turn around and tell agents, oh, don't worry, we're going to tag that 3% or however much it is onto the financing, we get a lot of borrowers at maximum financing that are going to be at zero or negative equity if we do that. It's just a fact. There's too thin a margin of error. There's a 2% margin of error in the appraisal anyway. So you start adding that on top of it. And if the housing market were to go on a dip at any particular time, especially, maybe you just bought your house 6 months later, the market starts to go down even slightly, you could be in a situation where you couldn't sell your house. Just that little bit of margin of error there. So I don't think it should happen, but we are getting constant questions about how are we going to deal with it. And it's difficult as lenders to even have a stance because we appreciate our referral partners. I do think that an adjustment was necessary. I really think that it should have been more of a self-policing thing where they said, listen, we see the issue here. We know, properties have appreciated greatly in the last 3-4 years, and it should be reflected in our commissions. Too late, horses out of the barn on that one. So that's kind of how I feel about it. I just don't know how we educate everyone when we're still so uncertain. And I really feel like NAR needs to lead the parade here and say, here's how this works, but they're silent. So.
Well, and I think, you mentioned this earlier, right? Realtors are looking to lenders because they need answers on what's possible.
Mhm.
Is it possible to finance or not? And in some cases it is, and in some cases there's been clear guidance on it, but in a lot of cases there isn't, or the clear guidance is absolutely not, which is VA.
Mhm. Mhm. Right. Right. And I really feel that's the one agency that is going to have to take a stand soon. They're going to have to come out with something, and they don't know what the result of the settlement is going to actually be. Now that the DOJ has kind of said, hold it, we may still have something to say. We might infuse ourselves into this particular case. They can't wait till July. They've got to take a stance now on how they're going to handle it, because it could very well get settled in July, and then here we sit, and we can't have veterans not being able to buy properties because they can't get representation. That would be a disaster. So they definitely have to come out and say something about it. But I've seen nothing so far. It'll be big news, I'm sure, when and if it comes out. But I do feel VA will address it. I think that they will probably. I think that they'll allow it to be paid. I mean, I don't know what choice they really have in the matter, because I think that they don't want their veterans discriminated against, not being able to buy properties because they don't have the money to pay for buyer representation. And I have forever been against dual agency anyway. It's really not a good environment for anybody. As I told you before, to me, it's like getting a divorce and having the same attorney represent both sides. It doesn't work. Right? You can't be looking out for the best interests of both parties when you have a vested interest in how both sides go. So I think that I think that they will have to come out with something, and I think that they would almost have to lean in the on the side of that the veteran would be permitted to pay for it. But I could be completely wrong about that.
Well, we have a question in the chat that I want to make sure we address from Karen Woods. And it takes us a little bit off topic from where we're at now, because you and I just went down a little bit of a rabbit hole with NAR, but she asked if we have any tips on breaking into doing business with builders. You mentioned that Adam's doing a podcast and he's got them on as hosts every now and again. Do you have any tips maybe for Karen?
So truly, if you want to do business with builders, first of all, you have to have a solid product. So our new construction product is really, it's in-house. We do a 2-time close product. It's not a 1-time close with modification. Not that there's anything wrong with that. There absolutely isn't. But you really need to be able to differentiate yourselves when you go to the builder and say how you can help their client. Because a lot of the builders, a lot of the bigger builders, they have in-house lending. Okay. I'll throw this name out there. So Ryan Holmes, which is a national builder, they have NBR Mortgage in-house. However, sometimes the way you can get into those builders is they don't approve everybody. Okay. They do have some overlays, and sometimes you're able to be that go-to person that does maybe a manual underwrite on an FHA or does something else that they don't offer. But I would say just make sure that you understand your construction product fully, And that when you are making an appointment with the builder, you already know what your game plan is. Are you offering down payment assistance on the product? Have you thought about, if it's a mom and pop builder, or I guess a non-franchise builder, have you presented to them how they can participate in a buy down, so that, which is very popular with builders, so that they can buy the buyer's interest rate down at the beginning? I think that's hugely popular, and a lot of the franchise builders are already doing that. So that's another way that you can get in. But really, you just got to differentiate yourself with, what do I have that your current lender can't offer you in the new construction space? Because that's what they want to hear.
Yeah. And I'll kind of build on that a little bit. You know, a lot of back when I was in the production world, a lot of my experience was in builders as well. We had an exorbitant amount of new construction where I was in North Carolina. And at the time, our team was like 55% new construction. So I mean, this was a significant portion of our business. And so you know, what Teresa just started to touch on was, you know, for your custom builders, those that need kind of construction financing, maybe a different approach than those that are regional builders or franchise builders, as she mentioned, the Ryans, the MI Homes, the DR Hortons, right? Those bigger kind of companies. There's very different approaches between the two. You know, for the specialty products can always get you in, but also they're all there to you know, look for home buyers, right? They're looking for exposure to the realtor community in some cases. And so I'd say just dig into what those builders are really looking for and look for ways to help them. If it's exposure to the real estate community, you have a plethora of realtors probably that you deal with on a regular basis that would probably love to hear more about ways to solve for inventory challenges in your market, right? So there's all sorts of things like that that you can do too. So hopefully that was helpful, Karen. I'll jump back into some of our you know, NAR settlement. We talked about the veteran impact. You talked about a little bit how your realtors are coming to you for questions. Are there things that you're doing to kind of proactively educate, or are you kind of waiting and just taking the questions as they come right now?
Yeah, honestly, it's a really difficult spot to be in, because all we can really do is say, listen, first of all, don't panic. Okay. That's number one. I think in 2010, everyone in the mortgage industry was completely panicked, right? Oh my God, nobody's ever going to make real, or loan originators are not going to get paid. At first, when the rules came out for brokers, it looked like everything they made, they had to give away. And it's like, okay, wow, this is a mess. So the number one is, don't panic. I believe, like any other industry, first of all, the real estate industry is resilient, and this is an adjustment period. Okay. It doesn't end it. It's just an adjustment period. But trying to figure out how you walk it is really going to be dependent on what ends up happening in July. You hate to wait, so you have to have a plan B. I know there are a lot of people looking at dual roles, right? There are already companies out there that are modeled to have licensed realtors as licensed loan officers. And that model works for some people. Our particular market, because we are so much referral based, if we tried to do that in our local markets, I think it would be suicidal, because they were like, wait a minute, you created competition for me, so I don't want to send any business to you. But it might not be a bad strategy in markets where maybe you aren't. Maybe it's a new market for you, and you approach a realtor and said, listen, this buyer's agent thing may have an impact on you. Would you be interested in maybe being dual licensed, and maybe find a way to create that partnership where they can be paid by actually performing some of the duties of a loan officer, and then handing that off to maybe someone within your organization that actually has been doing it longer and can facilitate that to closing. So, that's one thought. But I think just letting them know that it's not that buyer's agents can't be paid. And I think that listing agents, I can't imagine that a listing agent is going to go out and say, okay, I'm going to list the property for 3%. The only way that happens is if online pressure becomes too much. And there's going to be, I think, online real estate brokerage type situations popping up all over the place where they're, it's a discount brokerage where they're going to sell the house at bottom dollar. The reason I don't think that listing agents who have done this for many years are going to list below, way below market is because they know that they are going to need the assistance of a buyer's agent to market that house. That's all there is to it. If they educate their seller when they do that listing to say, look, we can do it for this, but it's going to greatly limit the buyers because the listing agent can say, yeah, I'm going to have open house, but I can't show the house 50 times. I need the help of an outside agent, and they're going to be the ones to negotiate for the buyer to show that value there. And also to say, listen, all the comparables that I have include a 6% real estate commission. So if we're not going to offer that, we really should pare it back, because I do think that appraisers may start looking at that information and pulling back those values based on whether there were or were not concessions, whether it be, a seller paid real estate comp, or just like closing cost concessions are in there today. I think that's going to be looked at. So I think a lot of this is going to be driven by the listing agents. And I think that they also realize that they might end up being the dual agent. Right. And so are they willing to do both sides of the transaction for 3% or 2%? Probably not. So I think that that'll have to be thought through, but it's just difficult to give anybody any kind of guidance with so much in the air. And I believe that once the settlement is done, that NAR will actually, I think, have something more to say about it.
Yeah, I'm sure. We've also talked a lot in the advocacy committee about kind of, and we've talked on the rundown here before too, about the State of the Union address, kind of the statements around CFPB's expansion into the fees in mortgage space. And then CFPB came out with kind of a memorandum of sorts that said that they were going to be looking into kind of junk fees. And just recently, there's been an article that says that the CFPB is considering a ban on charging buyers for a lender's title policy, right?
Yeah.
So I want to chat about that a little bit, because this would be a pretty, a pretty big shift in things, but I also think that it's really a slippery slope for our industry as a whole. So I'd love to hear a little bit of your thoughts, knowing everything we've discussed. Maybe you could share some of that with everybody here.
So I equate that, when they came out with that, I equate that with the car industry saying, hey, we need to take the airbags out of the car because the regulators don't like them. They're too expensive. Okay. It's like somebody making a decision willy-nilly about what's good for you and what isn't, and what you're willing to pay for and what you're not. Right.
Yeah.
I understand that lender's title is not directly beneficial to the buyer, but you're asking for a considerable sum of money, and that lender needs some sort of protection that they've got clear title, because we know there's a lot of title fraud that goes on out there too, right? There's tons of it going on. I mean, I think right now that you can go online and order some kind of insurance against your deed, or lock your deed, or do something to make sure somebody else doesn't take possession of it and sell it. So to say that we don't need it at all is ludicrous. And we all know in the industry that, again, no free lunch. Whatever happens is going to probably be passed on in the form of a higher interest rate, because there's no place for lenders to get this money. There's no place left. And nobody wants to have to charge a higher interest rate or try to get a premium price to pay for lender's policy, because you have to have it.
It is required, and so this is the slippery slope that I can see, right? You have a requirement for lender's policy regardless. But okay, I'm going to actually take this a little bit of a step back. She said this isn't a benefit to the buyer, of course, but neither is mortgage insurance, and buyers are supposed to pay for that, right? It's a requirement and obligation for them to have that. And so, I think there's a lot of areas that this could roll into, right? If we're not able to pass that one thing on to a buyer, could there be other things that we're required to do as a lender that we have passed on to the buyer in order to give them, the best possible market rate that's out there? I think there's just a lot of challenges I could see in this, right? If we're not able, if lender's title is a challenge, what's to say that a credit report is not a challenge and a VOE is not necessarily right? There's just all of those things we are required to do as lenders. And so I don't know, it's
I,
very,
th- you know, the one thing that came out, so in the State of the Union address, when they talked about getting rid of or limiting title insurance on refis, that to me kind of made sense, right? Especially since most of those buyers already paid for title insurance. They've been in the house for a number of years. Now they want to refi. Why they got to pay this again? Because when you know, even on a reissue rate, it's still like what, 70%. So I don't disagree that that's not a place to start, but that's the kind of compromise that they need to look at, and not let's just get rid of it altogether. Let's, because this whole idea that lenders are nickel and diming people, everybody that runs a shop knows better. We're being nickel dimed to death.
today for any lender to, I mean, the space doesn't allow for it, and buyers are extremely educated today with everybody's mobile phones in their hands. They're able to shop for rates. They're, yeah, I agree.
Yeah. I don't know where it'll end, but we all know in the business that we're getting nickel dime to death. The repositories have killed us with credit reports, right? 400% increase basically. And they have no competition. Where's the antitrust violation there? There's no competition. We also have other third-party vendors that have really gotten a license to just charge us whatever they want because they know we have to have it. And so for the CFPB to start singling things out and saying, oh, look at these junk fees, I feel like it's a diversion tactic about we got to come up with something that's causing, the high expense in housing. Let's look at the lenders instead of the problem, which is low inventory and higher interest rates. That's our problem. High interest rates will slowly take care of themselves, slowly. The inventory problem is another thing that should have been being addressed during COVID that wasn't addressed. They let that free lunch run too long. They had to know that builders, they saw the starts, they knew that it was declining. Nobody did anything. And I just feel like they're just trying to shine a spotlight someplace else because they don't have anything. They want to say that they're doing something about housing when this is not even a Band-Aid. That's just my opinion on it. And I'm hoping that they're going to come to their senses and throw that out. But definitely advocacy needs to go and say, look, guys, you're barking up the wrong tree here. Okay. That's not a junk fee.
Yeah, well, there's a couple of things. Number one, it's required by
Yeah, exactly. You're
our
going to go
regulators or our
well,
agencies, and so it's hard to be considered a junk fee. But
yeah, just
we
like the whole thing within our settlement, same way. They didn't think about, are the agencies going to allow them to finance it? What's the repercussions? They didn't think about it. Didn't matter. They're just, here's what we're going to do. Anyway, I know we're out of time. So
we are out of time. This has been such a fun discussion, though. But I want to be conscious of everybody's here's time. Thank you, Teresa, so much for joining us. I appreciate it. I appreciate your strong opinions and your ability to advocate for all of our TMC members as well. So thank you for being a part of our advocacy committee and sharing your insights with us today. For everybody that's here, if this was valuable to you, please follow us on YouTube, subscribe to our channel, as well as our TMC Connect podcast channel. And we look forward to seeing you again next week. Have a good weekend, everybody.
thanks.